Cryptocurrency and digital assets, a game changer in finance. Cryptocurrency has revolutionized the financial world, offering an alternative to traditional money and creating new investment opportunities. With blockchain technology at its core, cryptocurrency operates independently of central authorities like governments and banks. This decentralized structure ensures transparency, security, and efficiency, which makes it appealing to both everyday users and investors. In this article, we'll delve into everything you need to know about cryptocurrency, its origins, key players, how it works, risks, rewards, and its future in the world of finance. 1. Understanding cryptocurrency, the digital revolution. Cryptocurrency is a type of digital or virtual currency that uses cryptography for security, making it nearly impossible to counterfeit or double spend. It operates on a blockchain, which is a distributed ledger technology (DLT) that records transactions across multiple computers. This ensures that transactions are secure, transparent, and irreversible. Origins of cryptocurrency. The history of cryptocurrency begins with the rise of digital cash systems in the 1990s. However, it wasn't until 2009 that Bitcoin BTC was created by an anonymous individual or group under the pseudonym Satoshi Nakamoto. Bitcoin introduced the concept of a peer-to-peer, decentralized currency without the need for intermediaries. Bitcoin's success as the first cryptocurrency paved the way for other digital assets, such as Ethereum, Ripple, and Litecoin, which introduced new features and use cases. The evolution of cryptocurrency has since led to an explosion in the number of coins and tokens available today, each promising to address different issues or offer innovative solutions in the world of finance. How blockchain technology works. A blockchain is a distributed database that maintains a secure and transparent ledger of transactions. Each transaction is recorded in a block, which is linked to the previous one, creating a chain of blocks. These transactions are verified by nodes' individual computers within the network, making it extremely difficult for any unauthorized person to alter the transaction history. The decentralized nature of blockchain means that no single entity controls the network, reducing the risk of censorship or fraud. The technology is the backbone of cryptocurrencies and offers potential applications beyond digital currencies, such as smart contracts, decentralized finance DeFi, and non-fungible tokens (NFTs). 2. Major cryptocurrencies and their use cases. While there are thousands of cryptocurrencies in existence, the most well-known ones are Bitcoin, Ethereum, and newer coins with innovative use cases. Let's explore the top contenders. These emerging cryptocurrencies offer unique features like faster transaction speeds, lower fees, and innovative consensus mechanisms like proof of stake and delegated proof of stake, which are addressing some of the scalability issues faced by older blockchain networks like Bitcoin and Ethereum. 3. How to invest in cryptocurrency beginner to advanced. Step 1. Choose a crypto exchange. The first step in cryptocurrency investing is selecting a crypto exchange. Some of the most popular platforms include Coinbase, a beginner-friendly exchange known for its easy interface; Binance, one of the largest exchanges with a wide range of coins and low fees; Kraken, known for its security features and advanced tools; Wazirx, a leading exchange for users in India. Step 2. Secure your investments in a wallet. Once you purchase cryptocurrency, you must store it in a crypto wallet. There are two main types of wallets: hot wallets, software wallets. These are connected to the internet, making them convenient but potentially more vulnerable to hacking. Examples include MetaMask and Trust Wallet. Cold wallets, hardware wallets. These are offline and offer higher security for long-term storage. Popular options include Ledger and Trezor. Step 3. Crypto investment strategies. 1. Long-term holding, HODL. This strategy involves buying cryptocurrency and holding it for an extended period, hoping that its value will increase over time. 2. Active trading. For more experienced investors, active trading involves buying and selling crypto regularly to capitalize on short-term market movements. 3. Staking and yield farming. Some cryptocurrencies, like Ethereum 2.0, allow investors to lock their coins in a staking pool and earn rewards. Yield farming enables users to lend their crypto to others and earn interest. 4. Risks and challenges of crypto investing. While the potential rewards of cryptocurrency investment are high, it also carries significant risks. Here's a look at the major risks associated with crypto investments. 1. Volatility. Cryptocurrencies are known for their extreme price fluctuations. For example, Bitcoin's price can swing by thousands of dollars within a single day, which can be thrilling for traders, but risky for investors. The volatility can be both an opportunity and a challenge, and those looking to invest should be prepared for sudden market changes. 2. As security threats. Crypto exchanges and wallets are susceptible to hacks. In 2018, for instance, CoinCheck, a Japanese exchange, lost over $500 million worth of cryptocurrencies due to a security breach. To protect your investment, it's essential to use secure exchanges, enable two-factor authentication 2FA, and store your assets in cold wallets. 6. The future of cryptocurrency. 1. Mass adoption. Major corporations like Tesla, PayPal, and Visa are now accepting Bitcoin and other cryptocurrencies as payment. This mainstream adoption is helping to legitimize cryptocurrencies as a viable alternative to traditional finance. 2. The rise of DeFi decentralized finance. DeFi platforms like Uniswap and Aave are rapidly gaining popularity. DeFi offers decentralized lending, borrowing, and yield farming services without the need for banks or centralized institutions. This trend is reshaping the financial landscape by allowing people to access banking services in a decentralized manner. 3. Sustainable mining practices. Cryptocurrency mining, especially Bitcoin, has drawn criticism for its high energy consumption. However, the industry is making strides toward more sustainable practices. Ethereum's transition to a proof-of-stake pause model with Ethereum 2.0 aims to reduce energy consumption drastically. Additionally, Bitcoin miners are increasingly turning to renewable energy sources such as solar and wind. 7. Final thoughts. Is cryptocurrency the future of money? Cryptocurrency has the potential to fundamentally change the way we perceive and use money. Its decentralized, transparent, and secure nature makes it an attractive alternative to traditional financial systems. While there are risks involved, particularly in terms of volatility and regulatory uncertainty, the long-term potential for profit and financial freedom cannot be ignored. As the world of cryptocurrency continues to evolve, the key is to stay informed, start small, and diversify your investments. By doing so, you can position yourself for success in the ever-evolving digital economy. Cryptocurrency is reshaping the financial world, offering new opportunities and challenges. Whether it becomes the future of money depends on adoption, regulation, and innovation. Stay informed, Invest wisely and embrace the future. Like, share, and subscribe for more insights.